Welcome to PwC IFRS Talks, your source of all things IFRS, technical accounting matters, business issues, standard setting, and regulatory updates. I'm your host, Ruth Preedy. In today's episode, we're focusing on COVID-19, but specifically for those people that are just about to or in the process of filing some interim financial statements, whether they be quarters or halves. And to help me through that, I'm joined by Gary Berkowitz. Welcome back, Gary.
Hi, Ruth. Good to be again virtually back. Maybe one day that'll mean something soon.
One day we might be back in the office. We'll see. I'm quite enjoying the virtual world. Okay, so we're talking about, June might be, obviously not everyone does quarters, but it could be the first time you've done some interim financials. So let's focus on what you might specifically need to think through in an interim context. So if we start with like big picture IAS 34, what do people need to think about?
Okay, yeah, that's a good idea. Let's start big picture. So folks will recall IAS 34 effectively requires an entity to include an explanation of events and transactions that are significant to an understanding of the changes that an entity has undergone since the end of its last annual reporting period. Now, depending on your industry and the specifics of your operations, it's very likely that COVID-19 has had a significant impact or would be considered a significant event that might require additional disclosure and presentation in a number of areas in your interim financial statements. So some of the things listed in the standard we might expect to include as a result of COVID-19, write-downs of inventories, impairments of financial assets, PP or intangibles, changes in your business economic environment that affect fair value, loan defaults or breaches of covenants, which unfortunately there's been an increase of, and any changes in the fair value hierarchy, just to name a few. There's obviously a list. Now, even if you are, I guess, one of the rare entities that has not been directly impacted, it might still make sense to provide some form of messaging explaining how and why in your interim communication to the markets, that how you've been affected or haven't been affected by COVID-19, because I think it'll be information that investors will be looking for either from a positive, negative, or neutral perspective. So maybe just to summarize all of that, I guess big picture or the overall message would be, this year's interims might need to be a little bit more or a lot more detailed than what we would have expected in more normal times.
Okay, and if we go now, I suppose, into maybe some of the specific issues, one of the things you mentioned there was impairment, and we're always looking out for every reporting period, looking to see if there's an indicator for impairment from a non-financial perspective. What can you tell us about indicators for impairment?
Yeah, so I guess overall COVID-19 and the measures taken to control the outbreak are likely to have reduced future cash flows for many entities, or in some cases they've resulted in an increase in operating and other costs. And this means entities should assess whether there are any indicators that an asset or a group of assets may be impaired on the basis of both internal and external sources of information. So that's one of the requirements in IAS 36. And I think what's important to remember here is that when you're making this assessment, entities need to remember that there's a principle there. So is there an indicator that you aren't going to be able to recover the carrying value of your identified assets or your recognized assets? And so although there are the indicators we have in IAS 36, I think it's important to remember that that's not just a checklist. So maybe with that as a caveat, I'll now maybe list some of the things that folks should
give a checklist.
Yeah. We don't like checklists. So it's not a checklist. But if you were to put me on the spot and say, Gary, let our listeners know some of the things that you might need to think about when you're determining whether or not you've got an indicator of impairment. I might say, well, if you're focusing on internal sources of information, the most obvious one would be, is your actual financial performance significantly lower than the budget pre-COVID-19? Are your cash flows significantly lower than earlier forecasts before COVID-19? And then maybe more specifically, has there been any announced changes in your business model, any internal restructurings that are being planned, and or any discontinued operations? If we then move to external sources of information that folks may want to have a think about, have there been material changes in mid or long-term growth rates in your industry compared to the estimates before COVID-19? A very common one is your market capitalization. If you're a listed entity, is that now less than the book value of your net assets? And in addition, then just again, fluctuations in foreign exchange rates or commodity prices to the extent that you are significantly impacted by forex or commodity prices.
Okay, perfect. So nice long, not checklist, principles, examples to think through. And obviously, once you have got, you've decided you have got an indicator impairment, you're into IAS 36 and you need to do a full impairment review. We're not going to cover that today because we've only got our 20 minutes, but we have got another podcast on the impairment test with Paul Shepherd, and he talks through all the different things. So if you are coming across, running an impairment model and you haven't done one for a while, or you need some advice, and that's another good one to listen out to.
Yeah, definitely rather listen to Paul than me when it comes to that.
Well, I was not saying. I'm going to be recommending lots of podcasts throughout, Gary. So obviously impairment is, when you do the test, you are looking at the measurement of an asset, and there are other measurement issues that people might come across in their interim period. So maybe if you could talk us through some of those.
Sure, and I guess maybe one that's maybe not as obvious for folks, and I'll start with that, which is ECLs, because I think there's been a lot of focus on the impact of COVID-19 on ECLs for banks. And sorry, I normally hate using acronyms. So it's expected credit loss. So we're talking about financial assets, not measured at amortized cost. But I think the important thing here is that it affects corporates as well. And I think that's something that maybe folks have not thought about. So for example, it impacts your trade receivables, contract assets, or any other receivables that are financial assets. And I think COVID-19, as we've said before, has had a significant impact on economies and companies. And the economic environment has changed dramatically. And therefore, we would expect that the impact on ECLs, in many cases won't be able to be ignored. And I think what's important here is that, the assumptions and simplifications that corporates may have previously used may no longer hold, and you may need to be revisited, or they may need to be revisited. And I think in particular, a couple of things that corporates may want to think about, and that's whether or not you've had groupings of receivables that share similar credit risk characteristics. In some cases, that's a simplification that folks may have undertaken. Now, the credit risk profiles may have changed as a result of COVID-19. And I think then the one that also that at least resonates for me is, the inclusion of forward-looking information into the loss rates that you use and your scenario analyses. So again, if I think of a simple corporate, which is where I'm a lot more comfortable, a lot of the time you've got matrices where you've assumed a certain loss rate, and then you kind of add on what I think is going to happen in the future. And I think that is the input that folks really want to be focusing on, because I imagine our view of the future is very different from a pre-COVID to post-COVID situation. So I think the key message here is you probably want to look at your ECL assumptions and your matrices sooner rather than later, because there's probably a good chance that they may have significantly changed as a result of the current economic environment. I think maybe one other one to mention there is pensions. And I think management, to the extent you have material pensions, should consider whether any of the assumptions used to measure the employee benefits should be revised. For example, the yield on high quality bonds, expected final salaries, risk-free rates in a particular currency, all of that might have changed as a result of recent developments. And another more obvious one, still staying in pensions, is probably plan assets, which, as folks know, they need to be measured at fair value. And as we know, in the current volatile markets, the fair values of assets have been moving, unfortunately, in most cases in a downward direction. And I think the important thing there is, any remeasurement of the net defined benefit liability at the date that these assumptions change would be presented through OCI. But as I say, the important thing is, when you're looking at assumptions and measurements of significant assets and liabilities, don't forget about your trade receivables, other receivables, and pensions to the extent that they are material.
Brilliant. So more measurement issues. And obviously, we haven't talked about fair value in general, but that's another thing to think about if you've got things measured at fair value. We do, again, have another podcast on ECL specifically focused on corporates. To your point, Gary, it's sometimes something that can get missed in a corporate setting. So another thing to listen to there. IAS 34 also gives some guidance, I suppose, where there's annually determined items. So the thing that automatically comes to mind there is tax. And again, Dave Walters did a podcast with us where he's gone into more detail of tax, but can you pull out anything specific for interims that is going to be a challenge?
Yeah, sure, definitely. And I guess maybe before we go into the specifics, it's maybe worth reminding ourselves that IAS 34 has this concept that the frequency of your reporting should generally not impact the measurement of items. So in other words, you apply the same recognition principles for assets and liabilities as you do in your annual financial statements. But when it comes to measurement, in some cases, when you're preparing your interim financial statements, you need to apply what we call a year-to-date approach to estimate some of those amounts. And to your point, Ruth, taxes is a great example. So what this means from an income tax perspective is that your income tax expense for an interim period should be based on an estimated average annual effective income tax rate. And that sounds like a foreign language, so what this means, hopefully in more plain English, is if you expect your annual tax rate to be 20%, you generally apply 20% to the income before tax in your interims. That's what I think it's trying to say. Now, I think that the 2 points here that are worth mentioning is we understand it's very hard to know what the estimated annual effective rate is going to be when the future is currently so unpredictable. But I think the important point is that this still needs to be performed. And I guess we always reiterate that if there's some critical judgments or estimates that folks needed to make in coming up with that expected rate, you may want to think about that disclosure and maybe explain to users how you've gone about that so that folks are aware of the range or uncertainty in coming up with that estimate. And then I think maybe one last point is that there's also really some very specific guidance related to disallowable material expenditure and how entities need to consider adjusting that estimated annual average effective rate in these cases. We could probably do a whole podcast on that alone, and I probably need pictures. But I think the point is, with a lot of impairments in the pipe and a lot of them not being allowable for tax purposes, if you have a disallowable material expenditure, I'd suggest that it might make sense to look at guidance or chat to someone maybe like Dave or even myself.
You're going to be getting a lot of phone calls, Gary. I'm going to include your email address on the bottom of it, so you're going to have everyone going, can I have tax advice, please?
Yeah, maybe that wasn't the smartest thing to say on the podcast. You may need
generous with your time. So that's obviously what IAS 34 says. The other exciting thing that's happened in the last couple of months is the ISB's been beavering away, and they have issued one of the quickest amendments in all time, which was around IFRS 16, so leases, and around accounting for modifications, so if there's a concession. So with June, can we actually adopt that new amendment, and what does it tell us?
Yeah, and I think maybe before I do a quick summary of this, just maybe again reiterate, hats off to the ISB. I know a lot of the time folks are very quick to criticize how slow things move, but I think they did an incredible job of putting together an exemption to try and help folks in the current environment, so really playing their part as well. But I think
they could just rewrite a few other standards in 6 days.
let's not push our luck here. I think let's be grateful for what we got. But I think just to set the scene, I think we're seeing a lot of concessions for lessees, and the concessions take a variety of forms. But maybe the most commonly we're seeing them in the form of payment holidays and in some cases deferral of lease payments. Now, I think that the issue was it can be complex to assess whether those types of rent concessions meet the definition of a modification under IFRS 16, and if so, how you apply the modification accounting. So that was really the issue, as folks were saying, for some people who have hundreds, if not thousands of leases, to try and do that assessment in the amount of time they had was going to be very, very difficult. And so the ISB responded, and towards the end of May, they issued an amendment to IFRS 16 that provides an optional practical expedient for lessees only, and the expedient basically says to lessees, you don't have to assess whether a rent concession related to COVID-19 is a lease modification. Instead, lessees can elect to account for that type of rent concession in the same way as they would if they were not lease modifications. And so you might say, okay, well then what does that mean? So in many cases, that will result in accounting for the concession as a negative variable lease payment in the period in which the event or the condition that triggers the reduced payment occurs. So again, you might still be saying, okay, well, I still don't understand what that means. I guess what it means is that, for a rent reduction, you'll effectively reduce your liability because you didn't have to pay, but the liability went down, and there'll be a gain for the amount forgiven in the period that you get the rent concession. And if the rent concession was just in the form of a deferral, you would still get a P&L impact, but that would only be the difference in the present value of the delay in the payment. Now, and to answer the question you actually asked, Ruth, was can folks use that if they've got a junior in? The answer is yes. As I say, the amendment was published towards the end of May, and it's available for immediate application. But just a small caveat there. Just remember, if you are subject to any endorsement process, just check whether or not that amendment has been endorsed in your local territory.
Perfect. Don't worry, I did ask both questions. I just rattled them together in a very unhelpful way of like, tell us everything and tell us if we can adopt it. So you did perfectly and told us everything. As we're moving to the end of our 20 minutes, we won't get to disclosure yet. I've ruined the punchline. But let's start with the presentation. Presentation and disclosure and headlines for interims.
Yeah, so have we done a podcast on this already? I can't recall. We probably have done
it came out the other day.
Exactly. I was going to say, I'm sure I did it as well, but I think maybe just again to reiterate a couple of the headliners for folks, just to remember that additional line items, subtotals, and headings representing incremental costs as a result of COVID-19 are permitted by IFRS and IAS 1, but provided that they give more understandable information and they don't obscure other material information, so kind of use with caution. I think what's also important is, that if entities have an existing accounting policy on how they identify exceptional items or items that they've previously drawn attention to, they should be consistent with that previous policy unless there's a really good reason for changing it and you're prepared to be consistent with that change moving forward. And if you don't have an accounting policy, I'd say just think long and hard before you start adding specific things, because in theory that policy will need to be applied consistently in a post-COVID-19 world. I think another thing is that in some cases we've seen it's sometimes very difficult to separate the effect of COVID-19 from the effect of other external factors like reductions in commodity prices or general macroeconomic challenges. And so to the extent that it was difficult to try and make that differentiation when you're trying to draw attention to an item, it might make sense to be pretty clear in your policies and disclosures on how you've made that judgment. And lastly, if you're planning to include any new or modified alternative performance measures, it makes a lot of sense to consider any local regulator guidance, because many regulators, have been active in the space in terms of providing, by and large, or in most cases, pretty helpful guidance on what may or may not be appropriate. So that's definitely worth making sure you don't fall foul of any regulator advice in that area.
Perfect. I think we started big picture, sort of what does IAS 34 say, and if it's a significant event or transaction, you should disclose it. So let's close the loop and think about any other disclosure people should be thinking about.
Yeah, we always end with disclosure, which is I think in this environment very important. So so there are clearly specific disclosure requirements in IAS 34. It might be triggered as a result of COVID-19. I mentioned some of them at the beginning of this podcast, and I'm not sure folks want me here to recite the remaining kind of requirements from the standard. But I think maybe I'll finish up by saying I think it's important to reiterate the principle that I pointed out right at the outset, which is IAS 34 is trying to tell the story of what significant events or transactions happened between the last set of accounts and this interim reporting period. And so with that in mind, entities should ask themselves whether their disclosures make it clear to users how COVID-19 has impacted their results, their financial position, and the risks moving forward. And have they done that in a clear, transparent, and easy to understand way? Now, I know that's easier said than done, and that's really not an easy task. But I'm sure there's lots of guidance out there to help, and hopefully this podcast can act as one of those bits of guidance. So best of luck.
Good luck, everyone. Perfect. Thank you very much, Gary. That was really helpful. Lots to cover, and obviously, like we said, this is really just almost like to bring everything together if you're specifically going through interims at the moment. But there's loads more detail in other podcasts. We've also got the main piece of accounting guidance is our in-depth publication, and it feels like almost every day, we add additional frequently asked questions where we get questions. So please do click on Inform to see that, and it's also available on pwc.com. So thank you, Gary, for joining us. Come back. We could do another podcast soon. And everybody else, thanks for listening. Stay safe and happy accounting.
The preceding programme was brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitute for consultation with professional advisors.